Thank you for taking the time to join us for our company's financial results briefing for the fourth quarter and full year of fiscal year 2024. I am Sogo, CEO of AnyMind Group. I will now proceed with the presentation. First, I will share some highlights of our financial results. In the fourth quarter of 2024, we continued to perform steadily, with revenue increasing 42% year-over-year, gross profit increasing 41%, and operating profit reaching 877 million yen, achieving solid profit growth compared to the same period last year. For the full year, we achieved strong business growth and profit improvement, with revenue increasing 52% year-over-year, gross profit increasing 48%, and operating profit reaching 2.5 billion yen. As a result, we exceeded our full-year earnings forecast that was revised upward on November 14th. This slide summarizes today's presentation content. In 2024, we continued our high growth and profit improvement, achieving record high earnings. Additionally, we announced medium-term targets today, aiming for revenue of 105 billion yen and gross profit of 38.5 billion yen by 2027. Along with sales growth, we intend to steadily increase profits as well. Furthermore, we have resolved to conduct one M&A deal in Japan's e-commerce sector and initiate our first share buyback program. I will provide more details on these later. This slide shows our consolidated financial summary. For the full year 2024, revenue was 50.7 billion yen and gross profit was 18.8 billion yen, achieving high year-over-year growth and exceeding our earnings forecast. Operating profit reached 2.5 billion yen, exceeding the upwardly revised performance forecast announced in November, as a result of steady progress in revenue improvement measures. In addition, due to foreign exchange gains and the recognition of deferred tax assets from domestic and overseas subsidiaries, net income attributable to owners of parent amounted to 2.3 billion yen, significantly exceeding our performance forecast. Full-year results for FY 2024 showed revenue growth of 52% and gross profit growth of 48%, maintaining growth momentum with 8 consecutive years of revenue increase since the company's founding. Operating profit also showed significant improvement, increasing by 1.8 billion yen, up 242% year-on-year, with the operating profit margin substantially improving from 2.2% in the previous fiscal year to 5.0% this year. Let me explain our revenue performance by region. For FY 2024, the regional breakdown of revenue was Japan and Korea at 40%, Southeast Asia at 43%, and Greater China and India at 17%. Regarding gross profit composition, Japan and Korea accounted for 48%, Southeast Asia for 38%, and Greater China and India for 14%. In terms of growth rates, Southeast Asia in particular continued strong growth with an 81% year-on-year increase, while the Greater China and India region showed a 46% increase. In Southeast Asia, in addition to revenue expansion in our focus area of e-commerce business, we are maintaining strong growth in both the creator growth support business and the marketing business. In the Greater China and India region, our marketing business and partner growth business are driving business growth. In the Japan and Korea markets, our marketing and D2C e-commerce businesses continue their growth momentum, achieving stable growth of 27% year-on-year. We believe this has been a year in which we achieved the hallmarks of our group: global revenue diversification and sustainable growth. Let me explain our revenue performance by business segment. First, regarding the business segment breakdown of revenue for FY 2024, marketing business accounts for 42%, partner growth business for 39%, and D2C e-commerce business for 20%. For gross profit composition, marketing business represents 46%, partner growth business 35%, and D2C e-commerce business 19%. In terms of growth rates, partner growth business showed remarkable growth with a 67% year-on-year increase, while the D2C e-commerce business grew by 59%. The marketing business also achieved stable growth with a 33% year-on-year increase. We believe we are developing conditions that will further strengthen synergies between our business segments, including cross-selling opportunities as each business grows in a mutually complementary way. This slide shows our quarterly performance trends. In the fourth quarter, we maintained high levels of growth, with revenue growing 42% and gross profit growing 41%. For the fourth quarter of FY 2024, operating profit increased by 461 million yen compared to the same period last year, reaching a record high of 877 million yen. Adjusted EBITDA also improved similarly, reaching 12.6 billion yen in the fourth quarter. Let me explain the trend in SG&A expenses. In the fourth quarter of FY 2024, the ratio of SG&A expenses to gross profit was 84%, an improvement of 6 percentage points compared to the same period last year. We are implementing appropriate cost controls to ensure that personnel expenses, while increasing with business expansion, do not grow at a rate exceeding revenue growth. As a result, while continuing our growth investments in recruitment, we are achieving steady improvements in profitability. As a key indicator for measuring our profitability improvement, we are presenting the trend in gross profit per employee. Currently, we are focusing on strengthening and deepening our business foundation in existing countries and business areas. Through these initiatives, by promoting gradual productivity improvements and efficient business development, gross profit per employee has been steadily increasing. We consider the continuous improvement of this indicator as a critical management priority. Furthermore, while making steady progress in planned recruitment, we are achieving sustainable growth by balancing productivity improvement with business scale expansion. Here is our balance sheet position. In the first quarter of FY 2024, we raised 3 billion yen in interest-bearing debt for strategic investments and expanded our cash reserves. Regarding M&A execution, with our focus on investment discipline, the goodwill balance from our past 9 acquisitions remains at a healthy level of 2.86 billion yen, representing 0.117 times our net assets. Going forward, we will prioritize balancing sufficient liquidity with pursuit of strategic investment opportunities, aiming to enhance both financial soundness and corporate value while effectively utilizing interest-bearing debt. Now I will explain the performance of each business segment. In the fourth quarter, all business segments achieved growth of 30% or higher year-on-year on a gross profit basis. The group's overall gross profit margin was 37%, showing stable trends without significant fluctuations compared to historical levels. Here are the business segment results for the fourth quarter. The gross profit composition is as follows: marketing business at 48%, partner growth business at 33%, and D2C e-commerce business at 18%. Regarding growth rates, all businesses continue to grow steadily, with partner growth business showing particularly high growth rates. First, regarding our marketing business. On a gross profit basis, we achieved stable growth of 34% year-on-year in the fourth quarter. We continue to grow across all regions with influencer marketing as our core driver, with the Japanese market performing particularly well in the fourth quarter. Looking at the full year FY 2024, we achieved solid growth across all regions in terms of year-on-year gross profit growth rates. Japan and Korea at 35%, Southeast Asia at 31%, and Greater China and India at 26%. Looking at revenue composition by client type, we have built a balanced customer base with Japanese companies at 41%, global companies excluding Japanese firms at 35%, and Asian companies at 24%. By industry, we provide solutions to a wide range of sectors, not only in our main category of cosmetics and home care, but also in food and beverages, entertainment and media, travel, home appliances, and more. Moreover, even our largest customer accounts for less than 5% of revenue, indicating well-diversified revenue streams. In FY 2024, our client base for the marketing business exceeded 1,000 companies, with both the number of clients and revenue per client increasing compared to the previous year. Let me introduce the major awards we received in the marketing industry across Asian countries during the fourth quarter. In Thailand, our campaign for KFC received high recognition, while in Singapore, our campaign for Canon was highly acclaimed. Furthermore, our influencer marketing platform, AnyTag, won product awards in Singapore and the Philippines in recognition of its technological capabilities, innovation, and campaign performance. Regarding our D2C e-commerce business, we achieved growth of 34% compared to the same period last year. Our enterprise e-commerce support solutions continue to perform well, growing 46% year-on-year. With Archie from Malaysia beginning to contribute to our performance from June 2024, along with the successful acquisition of new clients across Thailand, Singapore, Philippines, and Vietnam, the business segment as a whole has achieved strong performance. Regarding changes in gross profit margin, there has been fluctuation due to changes in the sales mix, primarily caused by significant growth in enterprise e-commerce support transactions recorded on a gross basis. Our creator-focused D2C business, mainly operating in Japan, has maintained stable growth at 25% year-on-year. Let me explain the trends in the number of D2C e-commerce brands we handle and revenue per brand. Currently, we handled 176 enterprise brands and 47 creator brands. In our enterprise brand segment, we are successfully acquiring clients who are expanding their business across Asia. And as project scales increase, revenue per brand is also growing. In our creator segment, as the fourth quarter is typically a high season due to seasonal factors, revenue per brand has maintained year-over-year levels while both revenue and gross profit scale continue to grow steadily. On this slide, I will introduce recent client cases from our enterprise e-commerce support business. Especially highlighting some cross-border projects, we are supporting Idemitsu Kosan's racing engine oil expansion across multiple Asian countries, providing comprehensive support including e-commerce sales, marketing, logistics, and customer support. We have been supporting Suna, a Japanese hair care brand, for their e-commerce operations in Thailand, and have also started to support its operations in Vietnam. For the Korean cosmetics brand Forenkos, we have begun sales support in Vietnam in addition to Japan, including the utilization of our Gen AI-powered live commerce platform, AnyLive. Next, I will explain our partner growth business. This business continues to show strong growth with a 58% increase compared to the same period last year. In our creator growth support services, we are maintaining steady progress with the successful acquisition of new creators. In our publisher growth support business, although there were some industry-wide impacts of decreasing video ad demand, which resulted in lower ad unit prices in the fourth quarter, we achieved a slight year-on-year increase in gross profit through new client acquisitions. The number of companies contracted to our publisher platform, AnyManager, reached 1,118 at the end of the fourth quarter. While growth areas such as mobile app support are expanding steadily, primarily in Japan, revenue per publisher has been declining due to industry-wide decreases in advertising unit prices and an increase in customer acquisition of smaller-scale business partners, particularly in web media. The number of creators contracted to our Any Creator platform has exceeded 2,900 globally. Due to continued creator acquisition across all regions and certain seasonal factors in the fourth quarter, revenue has continued to perform well through the fourth quarter. Let me explain our creator support business's case studies and the rollout of new solutions. First, I would like to introduce our support case for Shinako, a creator and artist who has gained immense popularity among young people and boasts 1.2 million YouTube channel subscribers. We supported the planning and production of her music video and music distribution, and her new song Marshmallow Punch, released at the end of 2024, has exceeded 6 million views on YouTube. Furthermore, we were able to expand our support services as we have been certified as a YouTube Partner Sales Program partner. This enables us to have direct ad sales control on the YouTube channels of creators we support through an advanced reservation system, allowing us to provide new solutions for creators, publishers, and advertisers. We have newly established medium-term targets from fiscal year 2024 to 2027. We aim to maintain a compound annual growth rate of 27% or more for both revenue and gross profit, targeting revenue of 105 billion yen and gross profit of 38.5 billion yen by FY 2027. Regarding profitability, our basic policy is to continuously improve our operating profit margin, and we are committed to maintaining steady profit growth. Since growth investments will be crucial for maintaining high growth beyond FY 2028, we will drive our business while balancing long-term growth and near-term profitability. Let me share our vision for medium-term growth potential and profitability by business segment. While we plan to flexibly adjust our focus areas according to market conditions during the medium-term target period, Please understand this as our current outlook. Solutions for enterprise clients represent an area where we expect strong growth and high demand in both domestic and international markets, and where we can leverage our competitive advantages. Therefore, we expect continued high growth in both the enterprise e-commerce business and marketing business. Regarding profitability, as our e-commerce segment is a relatively new business area for us, and we are actively making development investments, its current profitability is lower compared to our other two businesses, providing an opportunity for significant improvement. For the partner growth segment, we have already achieved high profitability and expect to maintain stable growth based on market expansion. While we take a conservative view on growth rates due to the rapidly changing nature of this field, as this segment is currently achieving high growth, we aim to actively pursue upside opportunities. Let me explain our competitive advantages in solutions for enterprise clients. We provide marketing and e-commerce support solutions for enterprises, with a structure in place to offer one-stop support from brand growth to operations. Our strength particularly lies in cross-border expansion, where we can provide comprehensive support, from developing essential marketing strategies for market entry to localized e-commerce sales operations. Furthermore, we have dedicated teams across Asia and have built solid track records in each market. In the highly diverse Asian markets, there are very few players who can cover the same geographical area as we do, and our strength lies in our ability to provide optimized strategies tailored to each market's characteristics. Let me explain our growth direction. First, we will strengthen our enterprise support solutions across Asia. Currently, we have established marketing and e-commerce support solutions for enterprises in 15 countries and regions, with steady demand for regional projects and cross-border expansion support. Going forward, we aim to establish our position as a one-stop partner in Asia by further strengthening our infrastructure in each country, including logistics and import-export capabilities. Additionally, as each business segment grows, we expect our network of brands, media, and creators in each country to expand further. Through the growth of these local networks, we will enhance the value of our solutions. Furthermore, we will accelerate the evolution of our technology and solutions while improving internal operational efficiency through enhanced AI utilization. Given the remarkable recent developments in AI, we aim to establish our position in Asia by leveraging this technology. Let me explain our investment capacity outlook for this medium-term target period. Operating cash flow continues to expand, and we plan to reinvest surplus funds for growth. Our priority investment area is M&A with potential business synergies. If additional funding is required, we will prioritize interest-bearing debt financing with careful consideration of capital costs. Assuming a DE ratio of 1.0 or less, our current additional borrowing capacity is approximately 10 billion yen. Taking into account the accumulation of net assets from profits during the medium term, we estimate the total additional borrowing capacity could reach approximately 20 billion yen. While we have set our medium-term targets at levels achievable without M&A, given the attractive M&A opportunities across Asia, we aim to pursue non-linear growth through proactive M&A activities. Let me explain our earnings forecast for FY 2025. Regarding gross profit, which is our major performance indicator, we expect 27% growth year over year, in line with our medium-term targets. This forecast assumes an average exchange rate of 149 yen to the dollar and represents organic growth only, excluding any M&A impact. It does not include the M&A deal announced today. For 2025, we project operating profit of 3.5 billion yen with an operating profit margin of 5.4%. Operating profit is expected to increase by 37% year on year, with an improvement in operating profit margin compared to the previous year. For our business plan assumptions, we expect continued growth across all businesses, with marketing and partner growth businesses projected to achieve gross profit growth of around 20-25%, while D2C e-commerce business is expected to lead overall growth with a growth rate of 50%. Regarding SG&A expenses, while personnel costs represent the largest component, we do not expect staff increases to match revenue growth rates as we expand, leading to gradual improvements in profitability. Although not included in our forecast, M&A remains one of our key strategies, and we will actively pursue acquisitions when we identify suitable companies. Today, we have resolved to make AnyReach, a company operating in the e-commerce sector in Japan, a wholly owned subsidiary. This is our third acquisition in the e-commerce sector, following DDI in Indonesia and Arche in Malaysia. AnyReach develops and operates AnyGift, a platform that enables no-code integration of e-gift functionality into e-commerce sites, facilitating customer acquisition and e-commerce sales growth. Although their annual revenue for the fiscal year ending September 2024 is about 88 million yen, we expect this to become a high-growth business. The completion of this M&A stock acquisition is scheduled for the first quarter of 2025, with consolidation planned to begin from the second quarter of 2025. The e-gift market, where AnyReach specializes, shows promising stable growth both domestically and internationally. Given the high demand we observe in Southeast Asia, where we maintain strong networks, we are planning expansion into the Asian market. AnyReach primarily focuses on business-to-business solutions. We anticipate significant synergies through initiatives such as cross-selling, utilizing our enterprise client network. Regarding the team, led by founder Mr. Nakashima, AnyReach possesses talented personnel with extensive e-commerce expertise. Their integration into our group is expected to further strengthen our internal organizational structure. Based on this growth potential and the clear complementary relationship between both companies, we have made the decision to make AnyReach our subsidiary. Finally, I would like to report on the resolution regarding our share buyback program. This marks our company's first ever share buyback initiative. The acquired shares are intended to be utilized for future M&A transactions. M&A represents one of the crucial pillars in our business growth strategy, and we plan to continue exploring opportunities in this area. Our M&A strategy primarily focuses on acquiring talented founders and management teams. Our fundamental policy in PMI is to actively pursue business integration and group synergies. To this end, we aim to secure commitment from the founders of target companies toward maximizing group enterprise value. In addition to offering stock options and earn-out arrangements, we plan to use these treasury shares as part of the acquisition consideration to enhance their commitment to our group. Please note that the recently announced acquisition of AnyReach will be funded with our cash on hand, and we do not plan to use the treasury shares from this buyback program as consideration for this particular transaction. This concludes our presentation. Thank you for your attention.